have a quorum, so I'll go ahead and call to order the City Employee Pension Fund Board special meeting of January 31st, 2024. And welcome, everyone. We will start right off with approval of the minutes of November 14th, 2023. If I could have a motion.
So moved.
Thank you. Thank you. Now, are there any corrections, additions, comments? All right, all those in favor of approval, please say aye.
Aye.
Is anyone opposed? All right, that motion passes. Now, we have our second quarter expenses and our letter. Erin, would that be you?
We just don't have anything.
Much going on?
No. I shouldn't say, nothing out of the ordinary. How about that?
Okay. Well, in that case, you all have a copy of each in there, and all. This is FYI, but are there any questions?
On
Yeah.
these two letters, you mean the two memos? Is that what you're asking about?
The memo, the letter of transfer
Okay.
and the budget to actual and the detailed expenses. Does anyone have any questions?
I apologize, those pages got flipped in the packet.
It's okay.
I didn't notice. I just read the whole thing through and thought, okay. All right, so that was for your information. And then the ratification of the transfer letter, which is January through March. Do we usually do a quarter at a time? We do, don't we? So we will need, do we need approval of that? I think so.
Yes, ma'am.
So if I could have a letter of approval, I mean, a motion of
So
approval.
moved.
Thank you. Second. Thank you. Any questions? All right, all those in favor, please say aye.
Aye.
Is anyone opposed? All right, that motion passes. And then we have the memo of the three passings since our last meeting. And so some of those, do you want to take them? Is it best to take them one at a time? Some involve benefits and some don't.
We can.
Do
I
you-
think sometimes we do blanket, but we can do
Okay.
individual.
Okay, well, we can just, you all see the
Yep.
Ronald Hill, Adrian Justice, and Joanne Shields. And two of them, I believe, involve benefits, and then one no benefits. So if I could have a motion to approve, please.
So moved.
Thank you.
Second.
All right, thank you. Are there questions?
I do have a question
Mhm.
about the first item, the spousal annuity. I just want to make sure that I understand that, so we're paying out funeral benefits, but then his wife will still be receiving that $1,200 annually, or is that? Monthly, okay. Okay.
And on the same note, typically does the retiree select like the 100% or the 75% or 50% when they retire?
It is an ordinance-based.
It is ordinance.
Flat 75%.
It's flat 75, okay.
Yes, sir.
Thanks.
Thank you, Susan.
You're welcome.
And I don't know if we ever do it, but like I know we talk about it, but when we get a note like this, it might be handy also to still know that leaves us with X number of spouses, X number of retirees. I just think it's just nice to keep that in front of us.
Do
Actually,
you have
I
that
ran
number?
that right before I came down.
Oh, did you? Right.
We have 28 members,
Okay,
7 are retirees, 21 are widows.
okay. Thank you.
You're welcome. Kind of thought that might be asked.
Yeah, it's just handy to know it.
Well, it kind of gives us a perspective,
Yeah.
doesn't it?
Yeah,
As
yeah, it
our
does. Yep.
pension winds down.
Yep.
So Susan, if you can bring that each time, I think you usually do, don't you?
Yeah.
I usually try to before I
You
walk
just don't put it in
downstairs.
writing, yeah.
Yeah.
Okay,
So I
thank
have
you.
one more. So Susan,
Yeah.
those numbers, do they include Mr. Hill leaving the retired?
Yes, that,
Okay.
it includes the 3 passing.
Okay, thank you.
So as of January 31st, that's what the count is, or
So,
today's date.
Okay.
so it doesn't include them? The
No.
numbers don't include?
They're
that.
taken out.
Yeah,
So we will still be at 7 after we approve this?
it's the same
Yes.
numbers.
Yes, perfect, thank you.
Mhm,
Yes.
Same numbers. Uh-huh.
Good.
Other questions?
Just our condolences to their family.
Yes.
Oh,
Yes.
yes.
Of course.
Yes. Mhm. All right. All those in favor of approving, say aye.
Aye.
Is anyone opposed? All right, that motion passes. And last but not least, we have our investment review for the previous quarter. And I'll just say, take it away.
Sure. So, as many of you know, my name's David Calvert. I've been on this relationship for, I think, over almost 10 years now. And last quarter, because of the migration of the meeting to 2 weeks after our normally scheduled, Allison pinched hit for that particular meeting. But since that particular time, Colette Jacine, who has also managed this relationship for as long as its inception, resigned from the firm, and Allison's going to be taking over that primary responsibility. So Allison, I don't know if you gave a formal introduction last quarter, but maybe a more thorough introduction would be helpful this quarter.
Thanks, Dave. So I live in Atlantis, and I cover the Southeast. Colin was out of Orlando. I've been with the firm over 6 years. I'm primarily working with pension assets across the Southeast, just institutional clients. So I'm happy to not just pitch in or fill in, but be the permanent point person on the relationship for Lexington. Also here in Lexington for Foundation, we also manage assets for. So not located in the area, but we do have additional clients in the area. And I'll make sure Samantha has my contact information. If you have any questions in the interim between meetings, I encourage you to reach out to us, because that's what our role is, to service the relationship. We want to thank you for entrusting us to manage the pension assets, as we did win the rebid, but it doesn't go unnoticed. That we do appreciate, and the fact that you've entrusted us to manage the assets, and we'll do our best to meet your objectives.
Thank you.
Any questions or concerns?
I think we're all interested in what you have to say.
Sure, okay, very good. I believe everyone has a copy of the book. We have a few extras, so pass them back to the audience.
I hope this doesn't impact the migraine, or maybe.
It's okay. It is what it is. There's nothing we can do about it.
So on page 4 is a quarter-over-quarter snapshot of the return-seeking portfolio as well as the liability-defeasing portfolio. And as you will see, there was a significant increase in market value on both of the portfolios. And we will go into detail on why that occurred, but the return-seeking portfolio, which is a split of 60% equities, 40% fixed income, increased by $2.3 million. And then the liability-defeasing portfolio increased by about $320-some thousand, bringing the total portfolio to $34.65 million as of December 31st, 2023. You see the asset allocation at the bottom of page 4, and I'll let Allison talk about a little bit more in detail in the back part of the report. The other thing that we want to bring your attention to is that we received the actuary valuation. That valuation occurs as of June 30th of 2023, but the report takes a few weeks, maybe a couple months actually, to finalize. As of 6/30/2023, the actual liability is $5.5 million, and based upon in comparison to the market value of the pension fund as of June 30th, that represents the fund being overfunded by 578%. So significant overfunding. You can see that there was an increase from 2022 to 2023. That was due to market performance as well as a decrease in the actuarial liability. And if you recall, I think about a year ago, we instructed the actuary to decrease the funding ratio, decrease the assumption on investment returns, and that decrease actually increased the liability, but there was an offset to projected benefits as well. On page 6, for the return-seeking portfolio, the total return for the fourth quarter was 9.55%. The benchmark for comparison purposes was 9.51%, a very minimum slight outperformance of just 4 basis points. And you can see the liability defeasing portfolio had a return of 3.99%. That's a periodic return, so very strong performance because of a sharp decline in fixed income yields. And then during the fourth quarter, in November, there was a tactical overweight in U.S. equities that we reduced and removed it and moved the funds over to fixed income instruments. Over the course of the last 12 months, on slide number 7, the return-seeking portfolio generated a total return of 14.22%, and the liability defeasing portfolio generated a total return of 4.91%, which resulted in a combined overall performance of 11.84%. Going behind the next tab, page number 10, the economic perspective is still quite good. Everyone's still been talking about, over the course of the last 12 to 18 months, are we going to have a recession? But throughout all the major economic indicators, we're seeing pretty significant growth and strong fundamentals. The unemployment rate continues to be below 4%. This is one of the longest periods of below 4% unemployment since the early 1960s. As of December 2023, the unemployment rate was 3.7%. In 2023, 2.5 million new jobs were added to the economy. So it's still a very healthy number. Even though the rate of job growth is slightly lower than it was in 2022, this is actually good for the economy because the Federal Reserve was concerned that if we continue to have a lot more jobs being created and there's not enough employees, that's going to actually escalate wage pressures. And that would cause inflation to be more sticky and kind of resonate throughout the economy and just causing instability in prices. On slide number 12, the economy is continued to be powered by the consumer. There just doesn't seem like that there's any end to consumer spending, and that's because people that want jobs have jobs or can find jobs. In fact, there's about 1.5 potential jobs for everyone that's seeking a job. And because of that nice supply balance of jobs, there's not going to be a period of time where if you did lose your job from one company, you can't find another replacement job within weeks of being terminated from your prior job. So retail sales continues to be strong. The gold bar in the middle shows retail sales increasing at an annualized rate of 5.6%. And instead of people having to shell out money for gas and heating oil, you can see gasoline stations retail sales are down 6.6%. People are spending on food service, entertainment, and other type of expenditures where I think they're going to feel a lot better about it as opposed to, oh, I have to spend $80 to fill up my vehicle in order to go to work on a day-to-day basis. So people are able to have discretionary income that improves their lives as opposed to just meeting fundamental needs.
So is that a result of working from home across the country?
In terms of gas prices?
Yeah, I mean,
Yeah.
prices is one part.
Yeah.
But is there any of this that's a reflection of the telework environment shift?
I think there
That
has
you can
been,
tell?
not really specifically. Over the summer, we saw gas prices go up, but and I think that was much more driven based upon the geopolitical concerns in the Middle East. And as that kind of abated, not that there isn't a ceasefire in that area, people just aren't worried about the price of escalating oil costs. So oil has come down. You can see that in the price of the pump. But it's like instead of it being in the upper $4 range, at least in Pennsylvania, one of the things that I know, it's like Pennsylvania has the highest state gas price taxes on gas. So when I quote gas prices, it's like every part of the country elsewhere is lower. But the gas prices have come down. And you, if we have a chart on heating oil is lower as well. Natural gas, if that's what you're using to heat your homes, all those prices have come down substantially. And I think that maybe partly of COVID effects, where it's like there was just delays in transportation and additional cost for transporting goods. Anything to add?
Aaron, maybe to the point that the impact the telecommuter has had is on commercial real estate. So we are not corporate America, while they thought, we'll make the office place nice. We'll do all this ecosystems and lighting and all these efficiencies, nice office space. We'll bring you back. And people are like, I'd rather be home 3 days than go 5 days to a nice office. And we're continuing to see that in the commercial real estate market.
We're always really interested in that
So maybe
specific
it's not
information.
necessarily less usage, it's just kind of all encompassing of gas prices in general, or so just it's the downturn there.
Yeah. So CPI, we saw a peak last year. It was rising at 9.1%. I think everyone could have a story where, we saw the price of a dozen eggs approaching $4. All that has come down. Of course, prices have basically been sticky at those higher levels. But how inflation and how the Federal Reserve looks at inflation, it's a year-over-year cost, not how much the prices were 2 or 3 years ago. So now if you go to McDonald's, you're spending $10 for a Big Mac meal. But the price compared to last year, it's only up like 2 or 3%. But that's what the Federal Reserve is concerned about, year-over-year increases, not the fact that, prices were a lot cheaper just a year or two ago. On slide 13, it's like before you saw a lot of different sectors that had above average rates of inflation. Now the only two significant increases year-over-year are shelter and transportation. So if you're traveling on an airline, you're seeing higher prices than they were before. And then shelter costs, we've still seen a significant imbalance in the housing market, because if you own a home and you are in a mortgage rate of anywhere between the high 2% to 4%, if you buy a new home, that new mortgage rate would be 6.5% to 7%. So it just doesn't make sense for you to, I like that house down the street. It's going to be much more expensive even if you listed the house for the same exact price. So people aren't moving. If you are downsizing, there's not much benefit to downsize, because even if you spent $100,000, $200,000 less on the house, if you still have to have a mortgage, your payments might be the same. So there has basically been a supply imbalance on starter homes, where people that want to enter into the housing market just can't find any supply, which continues to keep housing prices elevated for everyone. GDP growth continues to be robust. This was printed just before the last GDP release, which was, I think, on Thursday of last week. Economists were expecting a 2.6% annualized increase. GDP growth actually increased by 3.3%. As you're seeing all these pieces of information that are good, that's part of the reason why the stock market has been healthy over the last 3 months or so. And one of the things that has really propelled the stock market is that the Federal Reserve is going to probably back off on their restrictive monetary policy. From the city's perspective, you're seeing much higher investment earnings on your operating fund balances, but in 2024, 2025, we're fully expecting the Federal Reserve to lower rates at some point in time. They have a meeting today at 2 p.m. I always don't like having a meeting on the same day as the Federal Reserve, because it could completely change the thesis of what we're talking about. But
We'll
everyone,
give you some leeway.
Right, exactly.
It's not till 2.
right. But everyone is basically saying that the Federal Reserve is going to remain on hold, no changes to the federal funds target rate of 5.25 to 5.50. But everyone's going to be concerned about the press conference on if the chairperson will actually provide any type of hints on when they might start cutting. I think the markets are anticipating May, but if it got accelerated to March, I think that would definitely move the markets in some more significant manner. And then just on slide 16, S&P 500, I show that the market, like, if you look at the index levels, it was up 24.2%, but when you include dividends, it was up 26.3%.
Let me take this page.
And I'll take it.
Oh,
Yeah,
thanks, Steve.
You're welcome.
Okay, so I'm going to talk about the markets and particularly incorporate some of the equity markets because that parlays into the multi-asset class portfolio, the risk side of the portfolio. So 2023, 2 topics that maybe we won't hear more about, but I think we will, and they Taylor Swift and the Magnificent Seven. So you couldn't go to a social event without one of those topics coming up. I guess it depends what generation you're in, but you needed to know a little bit about either of the two, right? So today we're going to talk about the Magnificent Seven. The S&P 500 delivered a third quarter return, a stellar fourth quarter return, the best quarter return it has generated in the past 3 years. So very positive for the U.S. equity markets. But let's take this into consideration that it represents 30% of the S&P 500. And you have 500 minus 7, you have 493 left in stock issues in the S&P 500. So they dominated the returns for 2023. If you look at an equal weight return for the S&P 500, where every single stock has the same weight, which is like 1.6%, it comes up to a return of about 11% for the year. So the Magnificent Seven dominated the returns for 2023. 2022 was a different story for the S&P 500. You recall the markets were double-digit negative, but those tech communication stocks rebounded significantly, surpassing the damage that they experienced in 2022. What does that mean for 2024? Well, so far they've gotten off to a very strong start, but there's concentration risk in these issues, so we have to pay close attention to that. What does that mean for the broader markets? Most from what Dave elaborated on the backdrop of the economy, it's really well suited for positive returns across the breadth of the market for other types of sectors in the S&P 500, like energy, utilities, consumer discretionary, consumer staples. So while we have generated a strong return, the markets for the fourth quarter and particularly year to date, we do see a positive trend moving forward. And really the beneficiaries will probably be outside of the Magnificent Seven. So others will participate in a strong market based upon the fundamentals we're seeing in the economy. But across, if you looked at the next page, across all major asset classes for the fourth quarter as well as the year, they really generated strong returns. The outlier, as we talked about earlier, are the commodities. Again, different story from last year where commodities was the stellar return for the markets, and this year off, and particularly as it relates to industrial metals and as it relates to energy as well. Where we also saw strong returns is for the fourth quarter, the Russell 2000, and that's your small cap area, as well as the NAREIT, your REITs. They delivered strong returns for the fourth quarter. They struggled over the year, really due to the face of higher interest rates. Bounced back as a result of the markets pricing in the rate cuts that we're anticipating in 2024 and taking advantage of that. On international markets, performed in line with the U.S. markets. on the backdrop that they are anticipating rate cuts, the ECB. But if you look at the emerging markets, positive returns, but not double-digit returns like you see in the developed markets or the U.S. markets. And really that's due to the growth slump in China. I was reading a few articles about China over the past couple of days, and the one word that was common in these articles was ugly. They're referring to it as ugly. They are in a slow growth period. They have issues with real estate overhang. They have issues with headwinds. That recovery is very slow. Easing was taking too much time. And you know, in the portfolio, we have emerging markets exposure, but we also have an emerging markets ex-China, because we do believe in emerging markets there are opportunities from a valuation standpoint, but as it relates to China, we put that on pause until we see better fundamentals. Investors will look at valuations. How do valuations look? And the valuations in China look great. They're so cheap. But if you really look at those true fundamentals, there are some issues that have to be worked out in China before we feel comfortable having a market exposure to emerging markets, which includes China.
Can we go back a second? Can you remind me, are there any, Dave, you probably know this, are there any non-tech companies in the Magnificent Seven, or are they all tech?
Two are consumer discretionary companies, and they are Amazon and Tesla.
Okay, thank you.
But I would argue whether or not they're really consumer discretionary, because that's like a lot of the valuations are driven
Yes.
based upon technology.
Yes,
Yeah.
yes.
So, yeah, Amazon, I've been interested, not necessarily on Amazon for the nice packages that arrive on their front door, but Amazon Web Services is a huge component of their overall valuation. And I've, for a long time, thought Tesla was just basically, EV cars. But know that the technology about having self-driving cars, that if they were able to leverage that platform in so many other areas, that's where the valuation is, and not car companies. Because if you look at Ford and General Motors, it's like they're generating billions and billions of dollars of earnings per year, and it's like you just saw GM's earnings this past week. They're just making money right over, hand over fist, but no one cares about it because they think that cars are all going to be gone. It's like I don't think so. It's like not in my lifetime. It's like
Tesla's not reporting.
what?
And recently, I don't know if you've seen, in northern Kentucky, Amazon opened the second largest indoor space in the country, second to Boeing.
Yeah.
Distribution?
Yes. And it's all, you go in there and it's all automated. It's robots delivering packages to be put on pods, to be roboted out to the planes. It is high tech.
Right.
It's
And you consider
pretty
that from
amazing.
with respect to employees. So we're replacing
There are
our
a lot.
human workers with robots.
Yeah, so I get that. Thank you.
So we'll move on to page 18, and this is a strategy overview, and it's not, consider this as what we're looking at and not where we are placing our investments. The portfolio is really on a strategic weights. We're not overweighting or underweighting any significant asset classes. Over the quarter, though, we did trim back on large cap. Why? Because the markets ran up so quickly. So we brought it back to strategic weights. We redeployed it across the equity markets as well as in fixed income. So we put the portfolio back to its strategic weights. Quick comment on where we are seeing opportunities. We still like the U.S. equity marketplace from a valuation standpoint, particularly with small cap and mid cap. The backdrop of the economy is best suited now, we believe, to move back into that area or potentially overweight, but still we haven't made any decisions. And for non-U.S. equity, we did put our position in on international small cap. International small cap is not a component of the benchmark, the all-country world ex-U.S. It's outside of the benchmark. Why do we have an exposure to international small cap? It's less correlated to the non-US equity markets. It has better risk-return exposure and opportunities, and we still do have it in the portfolio. We put it in last quarter, and we're still long the position, and we do see that the fundamentals there are strong. And then if we look at, and then just emerging markets. We like emerging markets, but again, it's just being very cautious of our exposure to China. We do still have exposure to China, but we still are, as an emerging markets exposure, somewhat underweight to the market for China. Factors to consider on the next page, I'll focus on a couple. Dave really did a great job elaborating on monetary policy, economic growth, inflation. So great, we've seen inflation come down considerably. It's just going to be harder. We came down from 9 to 5, 5 to 4. I mean, just getting down to that 2% range is just, it's like the last 2 miles of the marathon. It's like, can you do it, right? You can do it, but you're just going to have to really dig in. Labor markets, and in addition to a strong labor market, people who left the workforce during COVID are back in. So their more participation rate in the workforce is positive, and the U.S. consumer completely continues to be resilient, and that was really the trend all throughout this past year, and they continue to show strength by purchasing and spending. One area that I think is important to look at, and it could be these black swan events that are lingering, Dave did touch upon it, political risks. We do have not only the Russian-Ukraine issue, but we do have that really is in our backyard, the issue as it relates to the war in Gaza and how it will impact us from a U.S. standpoint. So we have to be mindful of if we are to get further involved and to what extent we will be involved. And then lastly, which people are talking about, is we have an election coming up this year. And so that will have a trajectory on the markets, not long-term historically, but they do short-term. And I went back to get just some information. People do ask, will it have an effect on the markets? And our investment committee has been very strong to say, short-term, yes, but long-term, not so much. But since the inception of the S&P, the markets provided positive returns 19 of the past 23 election years, which is a pretty high percentage. If you remove 2 of those years, one was in 2008, global financial crisis, and then you have the other, the tech bubble in 2000, kind of those are anomalies. The market was only down 2 out of the last 16 years. So it has, election year does have a positive impact on the markets, but I think, albeit it would be, short term, if that's the case. I'm going to move it over to the portfolio. Is that okay, Dave? Is that okay? Okay. Talking. On section 3, the numbers aren't clear on the bottom, but it's 2.1 or 29. So for the quarter, we outperformed slightly. For the risk-return portfolio, this is a 60-40 portfolio, incorporating both U.S. and non-U.S., as well as fixed income exposure. I did talk a little bit about our positioning in the portfolio. Across the asset classes, really one thing that helped the returns for this quarter were our active international equity managers, which have struggled, right? And so this quarter they rebounded. Also on the U.S. equity side, we did have a couple active managers that underperformed, but in general I think we're closely aligned with the market, with the domestic equity returning about 12% and the index at about 12.1%. And you'll notice if you look on the following page, that second line, emerging markets ex-China, this is really highlighting having an emerging markets exposure without China delivered a double-digit return for year-to-date, as well as the as year-to-date as well as the year, not having that exposure to China for the portfolio. Lastly, what was I going to say? you look at our year number. We're not happy about our year number, where we underperformed, as Dave mentioned on the first page, about 130 basis points. That's not our objective in the portfolio. And the rationale behind that is the small cap exposure, overexposure we put into the portfolio the first quarter, which trailed into the second quarter. And this, we put that position on prior to the collapse of some of the regional banks, which really impacts small cap and mid cap equities. And then in addition to that, we also had an exposure of an equal weight S&P, which, as mentioned before, did not generate returns of an S&P 500, because the S&P 500, the drivers of those are the Magnificent Seven. And equal weight, they all have an equal weight in that benchmark. So that dampened the return for the U.S. equities. So primarily for 2023, it was our U.S. equity market, our portfolio really underperformed and was a drag on the portfolio and hampered performance because of the overweight small cap and our equal weight in the S&P 500. And then lastly, we have not made any changes in the portfolio for the quarter, significant, just bringing you back to tactical weights. And we do believe that we'll remain at the 60-40. We really much are in line, as you look on page 26, with the major asset classes, U.S. equity, non-U.S. equity, as well as fixed income.
Questions? Anybody have questions? It's a lot of material.
I just have one. Because I think the actuary said our liability was somewhere in the beginning, 5.5 million, and we have 7 million in our liability defeasing portfolio.
8.2 actually.
8.2.
Yeah.
Do we need to contemplate a transfer of assets from liability defeasing to the return seeking?
That is definitely on the table, and it will be justify that it's like those are extra excess access.
Right.
Of course, everyone knows that the S&P 500 is at an all-time high.
Yeah, sure.
So when do you do it? Is always the question. So Allison here says that presidential years are good years, so maybe you do it.
Oh wait, that's big.
So, but that is the question, and sometimes when the markets are down, that's when, oh, okay, it's nice to have the extra liability defeasing portfolio, and you're not really tempted to add. So
I just think if our strategy is to have two portfolios, like we should pay attention to what the actuary says our responsibility is.
Yeah.
And
Yeah.
that's just my thought.
A suggestion would be to run the capital markets assumption for the close of 2023 for the 60-40 portfolio. So you can get, no guarantee, but you can get a good estimate of the probability of returns for 60-40 portfolio, your portfolio, over the next 5 years, over the next 7 years. Mm-hmm. And then you can measure that against the fixed income portfolio. And from a fiduciary standpoint, right? Because you're not looking at what 2024 is going to bring for a return, but you are looking a few years out for that risk return portfolio. So that would be a suggestion, and that we could run that for you to have a conversation around that.
I like that idea. That was going to be my question also, Dave, when I looked at that. And I mean, we don't, I think what we don't want to end up doing is trying to go back and forth and back and forth. But we do want to be smart about which portfolio our money, is in. So what do you all think? I think that makes sense to.
We could do it for the next, it's up to you, but next quarterly meeting, we can run a model portfolio and then give you an idea.
I think we should, because I mean, I think if we also look at our actuarial liability probably, I would be kind of curious as to what they've got as our terminus date, like if they think we've got 10 years left, or, like, because I think if the runway's long enough, it doesn't necessarily matter as much, right? It's just like, okay, the runway's long, so as long, like, the market is the market, and it's gonna, over the long term, is gonna do whatever it's gonna do. But if that's your recommendation, I don't quite understand what you're saying, but it's okay. But
Because it will give us more information.
yeah, just more information to make the decision.
Yeah.
Yeah.
I think what has always been the question is that who's the primary beneficiaries, which is the current beneficiaries, or should we try to increase our returns over the life of the next 20 to 30 years? With the actuary, where it's just like, there's a long tail, and that's
Yeah.
shown on 38, where on the actuary report, there is an estimate of 0.1 persons that's receiving benefits
Right.
after 2040. That's either yay or nay.
Right.
It's not going to be 0.1,
Yeah,
it's
yeah,
either 0 or 1. And that's where it just has a very, very long tail when you're looking at that from that perspective. And as we've already kind of discussed, it's like the number of beneficiaries continues to decrease over time. And one of the things that has always kind of changed the numbers is the not necessarily one time, because the increases to the beneficiary payments, I think that
Yes.
occurred,
It's
just in
occurred a
20?
few, let's see.
Yeah, few
Yeah,
This year, last year,
It seems to happen each year, doesn't it?
well, it's only
In recent
recent.
history.
It's only
It's only
recent.
recent that
Yeah,
we've done that,
okay.
but that's what I was thinking is, I think I would like to be sure that we are able to do that,
Yeah.
because, and Charlene can attest to this, so many of these folks retired decades ago.
Yes.
And so their pension can use some lifting,
Yeah, I would
right?
agree with that.
Yeah.
and that's where there is a COLA increase, I believe, already incorporated.
Yes.
And that's already incorporated in the actuary estimates.
Yeah.
But if you were doing an additional bump,
Yes.
that would
Okay.
increase the liability. And I think there's always been a one or two meeting discussion about increasing the benefits. So then all the numbers have to kind of factor into the actuary report
Okay.
and what is the post implications. But now we're so overfunded,
Yes.
we definitely could probably move easily $1 million or more from the liability diffusion portfolio and still have the one-time
Yeah,
increase
still have
as
it.
well.
Yeah.
We've traditionally, Erin, you can correct me if I'm wrong, given the extra bump based on what our own current employees received in an increase.
Yeah, the last couple of times, that was the conversation.
Mhm.
That was, how we determined how much
Mhm.
increase was going to be there. But prior to that, I think it was arbitrary at some
random.
point. Yeah, it was, more modest.
Mhm.
We know the last couple of years have been a struggle for our retirees, and been trying to
And we learned
be responsive to that.
We learned a lesson along the way. One year we gave
Yes.
a supplement, and that hurt some of our retirees because it messed with Social Security, and so we didn't do that anymore. So,
Okay.
would you all like
Yeah, I
this
think it's
extra
good to just
information?
have the knowledge.
Mhm. If you could do that for the next
The next
meeting.
Yeah, that'd be helpful.
Okay, good.
I just have a really general question, and I don't know if it's because I have a really good headache, or I just am not remembering, but it seems like every time we talk, our return-seeking portfolio is underperforming the benchmark. And it maybe has since I've been on this board. I mean, it seems like we are struggling, and I don't know that I necessarily understand how we determine the benchmark and then what we do to at least meet it. What is happening that we're underperforming? Is there something we should be doing that we're not doing? Is there a recommendation that you all would have that we would change? I know that you're doing exactly what we told you. We put forward our investment strategy. We say this is how we'd like you to do it, and you're following that. But we don't do this for our living. We do this as extra. You know, and I want to make sure that we are addressing anything that we can and should change, because we did look at our investment policy this year, and, you know, we do have the two strategies, and I think that that's good. But I don't necessarily understand why we're not quite there.
Yeah. It's a multi-factor, and we could dive into a lot more details, but the onus on the comparison against the benchmark is really on PFM as being the investment manager. So we are making some decisions that haven't gone well in 2022 and 2023. If you look at performance prior to 2022, it's like we had a much stronger performance, but it's been
I recognize
turbulent
my
issue.
purview is short comparatively.
Yeah.
Some, well, some clients will not ask that question, but your question is valid, and the onus is on, as Dave said, us. You're doing your role. We're following the IPS, but the onus is on us to deliver those returns. We have made some changes internally on the investment committee team. We've incorporated, one of the issues for performance for this past year was our overweight we took to small cap and mid cap, which was significantly impacted by the regional banks, the collapse of those banks, which fall in the small and mid cap. We put that particular overweight on right before the collapse. So unfortunately, it was a real drag on performance, as well as the equal weight, because we weren't participating in that market ride that Magnificent Seven had demonstrated. Our investment committee has and then the year before, for 2022, is a lot of our active international equity managers. Since 2022, our investment committee has incorporated models to really monitor manager by manager basis tracking error. That's something that we needed to improve on, which was done in part of 2023. In 2023, we added 2 subcommittees to work in conjunction with our investment committee, which is an 8-member team. The two subcommittees, one is a portfolio construction team, and one is manager research. Both of these subcommittees include committee members from the investment committee. Floyd Simpson, who you met at last quarter's meeting, he's one of our investment committee members. He is also on the portfolio construction committee. So some of them have on 2. We also have committee members that come to us from US Bank, who we were acquired by. This is giving us an extra layer of risk oversight and manager due diligence, and we incorporated those 2 subcommittees this year. So again, the onus is on us, and we have made changes internally to address those issues so that we can deliver on what your expectations are. So your question is right.
And one of the things that is, without being defensive, is that one of the things that we've always strived for is diversification. And right now, the market is being powered by essentially 7 companies, Magnificent Seven. So when Allison said, we are exposed to small and mid cap, we're looking at the valuations. If you're seeing that you could buy small and mid cap at a significant discount from the large companies, for us that would mean that it's like, we should diversify our assets and have greater exposure. Those have been basically wrong decisions in a rising market environment. When it's being powered by Microsoft, NVIDIA, Google, or Alphabet, and just a few names.
It's kind of a huge shift, isn't it? I
Yeah.
hadn't thought of that.
Yeah.
Diversity's always been the key.
Right.
Absolutely.
Exactly. So if you're buying an S&P 500, you're thinking that you're getting diversity over 500 companies, but you're only getting 35% is just those 7 companies.
Yeah, and don't forget, NVIDIA bought Enron, and we don't have to. It's that whole, think if we were value managers focusing on value companies, they were completely destroyed this year. So it's been a really interesting, it's just an interesting, very interesting market environment, so.
Yeah. It's not an excuse, but it's like,
Yeah.
we definitely do value diversity, and diversity is not paying off right now.
But given the and I am by no means an expert in this, but given that tech is going to be with us forever, I think.
Yeah.
And high-tech businesses, maybe this is the shift for the future,
Right.
for
But,
a long time.
yeah, but this is one of those interesting things, that Microsoft released their results yesterday, and they showed 30% revenue growth in certain components. The markets actually didn't like that, and I think Microsoft has actually come down. So you're looking for these companies to be priced for perfection if there's any hiccup. So iPhone, have you all upgraded to your newest iPhone? Is that a slippage that if you're not buying a new iPhone every year, it's like they actually might see Apple's share price come down? We're going to start seeing a slight decrease because of China. Apparently, the new fad in China is actually flip phones, which is just so ironic because it's like at one point in time, it's like everyone moved away from flip phones.
Been there, done that.
That's mine, in good shape.
But the promos for iPhone, the numbers are looking good, but over the summer,
Could they continue?
yeah.
And their PE ratios are over 50%, and the PE, and for the rest of the S&P, it's 19. It's like, it's,
Some of us
Crazy.
like Androids.
That's right.
Right, Dave?
That's right.
my husband, because, yeah, no
Follow the
one steals your,
Imperial
no one
Wisdom
steals your
Masters.
charger. Yeah, that's my husband says. Steals my charger.
So,
Well,
Aaron, to your
Well, I
point,
appreciate the explanation.
Yeah.
I just want to make sure, we really spent some significant time as a group trying to evaluate where our level of risk and our level of comfort is, and, didn't move too much because of what this fund is intended to do. And I just wanted to make sure that we're kind of,
it is
in
definitely
line.
a good question, and I don't know if it would be a good thing or a bad thing, but if Microsoft, Alphabet all slip up, our portfolio is going to look very good. Relative, but then I think everyone's personal portfolio,
Yeah.
it's like, you're not really patting yourself on the back because a lot of retirement plans just look at 401ks with like the S&P 500. And the idea of having greater exposure to those smaller, cheaper companies with the equal weight, I thought that was very tempting, but it didn't pay off, so.
what other questions do you have? Any? All right.
And then on your shift, I think one of the questions, and you could maybe even start exploring, would be better to do it on like a dollar cost average. Let's say we want to move $1.5 million over to the return seeking portfolio. Should we try to do it on a quarterly basis?
So it's not all
Right.
at once.
And then just kind of have committee approval that we make the decision, but then maybe implement over a course of 6 to 9 months.
I think, from my perspective, I'm looking at you to make that recommendation.
Yes.
So that we would make it in the form of a motion.
Agree.
Right.
Okay.
Because
Yeah.
this is what you do,
Yeah.
and I agree with that
Okay.
concept and strategy.
Typically, what we would do, we turn to our portfolio strategists and
Yeah.
ask them, how should we implement this dollar amount?
Yeah.
And 9 times out of 10, it comes up dollar cost.
Yeah.
But, yeah.
Okay. Anything else from your perspective? And any other questions? Do we need to vote to accept this or not? I mean, it is what it is. Well, thank you very much for that report, and we'll look forward to what you bring us in our next meeting. And Allison, welcome aboard. Atlanta's just a quick flight from.
It is.
Delta will bring you here in an hour.
Only Delta.
All right.
Yes.
Is there anything else for the good of the whole before we adjourn? All right. Could I have a motion, please?
Move to adjourn.
Second.
All right. All those in favor say aye.
Aye.
We are adjourned. Thank you very much. Great to
Thank
see
you
you
guys.
both.
Take care.